Howard Marks on cyclical nature of markets. Greetings, fellow investors and lifelong learners. Today, we're veering away from the usual discussion of short-term gains and directing our attention to a topic that might strike you as peculiar in the world of finance: love. Yes, you heard it right. We're about to delve into the intricate relationship between investors and stocks. It's our comprehension of the financial ecosystem, rather than our knowledge of individual stocks, that guides us toward asset investment. Howard Marks, a revered investor, astutely noted, "If the system collapses, safe money will be worth zero." Warren Buffett once said, "When I see memos from Howard Marks in my mail, they're the first thing I open and read. I always learn something," and that is doubly true of his book. So, he is an investor worth paying attention to. So, join us today as we shift our perspective from viewing investing as a mere means of wealth accumulation to regarding it as a relationship that needs nurturing and development over time. We aim to shine a light on the approach of value investors, the unsung heroes of the market, who achieve long-term success by identifying enduring qualities in stocks and forming lasting partnerships with them. As per Howard Marks, there's no such thing as a good or bad idea, regardless of how it might seem at first glance. Marks underscores the cyclical nature of markets and cautions against ignoring the inevitability of economic downturns and shifts in sentiment. According to him, the emphasis should always be on maintaining a cautious and rational perspective, especially during periods of economic euphoria or despair. After all, as Marks likes to say, the biggest investing errors come not from factors that are informational or analytical, but from those that are psychological. To navigate through market cycles successfully, Marks advises us to follow these principles. 1. Be aware of market cycles and anticipate their turns. Understanding that economies and markets move in cycles can help you avoid the pitfalls of market extremes. This does not mean trying to predict the exact timing of cycle turns, but rather recognizing when market sentiment is becoming overly optimistic or pessimistic. 2. Be contrarian to achieve superior returns. You must dare to be different. When everyone is buying, it might be time to sell, and when everyone is selling, it might be time to buy. This approach requires courage, patience, and a solid understanding of market fundamentals. 3. Insist on a margin of safety. Marks suggests always investing with a margin of safety, which means buying assets at prices that allow for potential adverse events or miscalculations. The greater the margin of safety, the greater the potential for profit and the lower the risk of loss. 4. Understand and control risk. Many investors tend to focus solely on returns, but Marks reminds us that understanding and controlling risk is equally, if not more, important. This involves evaluating the likelihood of a permanent loss of capital, understanding the riskiness of each investment, and never investing in something you don't understand. 5. Be patient and disciplined. Successful investing often requires resisting the emotional influences of fear and greed. Patience and discipline are vital for avoiding the herd mentality that can lead to buying high and selling low. 6. Be flexible and opportunistic. While it's crucial to have an investment strategy, Marks advises us to remain flexible and open to new opportunities. This means being willing to change your mind when the facts change and taking advantage of mispriced assets when they become available. Early cycle phase. The economy is quickly coming back from recession in this phase. Credit markets begin to grow again as monetary policy is still easing. Interest rates are falling, which adds money and liquidity to an economy weakened by the recession phase. Corporate earnings grow. People spend as a result. The best sectors during this phase include consumer cyclicals and financials. Bonds can also be good because bond prices tend to rise as rates fall. Mid-cycle phase. The mid-cycle phase tends to be the longest of the cycle. The economy is stronger, but growth is moderating. Interest rates are at their lowest, and corporate earnings are at their strongest of the cycle. The best sectors here include industrials as information technology, and basic materials. Interest rates are moderating and perhaps starting to rise as the Fed tries to fight inflation. Late cycle phase. Growth is slowing and begins to appear overheated in this phase as inflation climbs higher, and stock prices begin to look high compared to earnings. The best sectors in this phase include energy, utilities, healthcare, and consumer staples. Recession phase. Economic activity and corporate profits are falling. The stock market may have entered a major correction by this point. Interest rates are at peak levels. The best sectors in this phase include the same sectors that began to gain favor in the late cycle phase. But this phase is the shortest, often less than a year. Moving into early cycle phase sectors can be considered. Why fall in love with stocks? So why do we need to fall in love with stocks? And why should we focus on buying assets? Just think about high school for a moment. those popular kids everyone admired, were promised a thrilling future. Yet as time went on, their glamorous facades often crumbled, leaving a trail of broken dreams. But then there were the quiet observers who diligently worked on their craft, those who didn't seek validation but instead focused on building a solid future. These are the ones who ended up achieving true happiness and fulfillment. The same principle applies to investing. We're not seeking the flashy, headline-grabbing stocks that may soar high today and crash tomorrow. Rather, we aim to identify the overlooked and underestimated stocks, the ones with solid foundations and potential for steady, long-term growth. These are the stocks we want to fall in love with, companies with strong fundamentals, robust management, and enduring potential. Our affection for the stocks we invest in can help us stay committed to our decisions through major market fluctuations. Isn't investing similar? We're not in pursuit of fleeting infatuations with skyrocketing stocks today that might plummet tomorrow. Our aim? To forge bonds with stocks that may seem unassuming but are founded on strong principles, promising slow yet steady growth. The stocks we want to fall in love with embody stability, with a robust management structure and long-term potential. Mark's perspective on risk. Let's delve deeper into Howard Marks' perspective. He says that each investor should understand their normal risk posture, which will depend on various factors such as age, wealth, income, financial commitments, aspirations, risk tolerance, and more. Marks suggests defining this on a scale from 0, risk-free, to 100 total risk. In essence, Marks argues that it is crucial to strike a balance between maintaining what you have and seeking to increase it. He points out that all attempts to grow capital carry a risk of losing a portion of your current wealth. Hence, the decision to adopt a defensive or aggressive investment strategy should depend on one's personal balance and the current market conditions. Marks' approach reminds us of a famous Warren Buffett quote, "Be fearful when others are greedy, and be greedy when others are fearful." This principle can help you to balance the preservation of your current wealth with the pursuit of future gains. It's a delicate act that you need to master in order to build long-term wealth. However, keep in mind that there's no one-size-fits-all answer to this. The correct level of risk for you will depend on various personal factors, such as your age, wealth, income, responsibilities, aspirations, risk tolerance, and gut strength. This means that an investment that is good for one person might not be good for another. An investment that was good for you at 20 might not be good for you at 40, as your circumstances may have changed. Remember, when people come to me for financial advice, I often ask them, what's more important to you, preserving what you have or increasing it? And they usually say, both. But the reality is, you can't have both at the same emphasis. And any effort to increase capital invariably introduces the risk of losing some of what you already have. So you must make a decision on the balance between aggressiveness and defensiveness. Then you can think about varying it over time as circumstances dictate. The core aim of investing is to achieve the best possible risk-return ratio. But one person might prefer a lower return in exchange for more security, while another might be comfortable taking a higher risk for the potential of a higher return. Each individual must find their own balance between aggression and defense, and this personal equilibrium may change depending on circumstances.